For most of the past 3 decades, the developed world operated under a comfortable assumption that the global trading system had become so deeply integrated, so mutually beneficial, that no rational actor would deliberately fracture it. Energy would flow west, capital would flow everywhere, and manufacturing supply chains would optimize themselves across borders according to pure economic logic. The system, we told ourselves, had evolved beyond the crude territorial contests of earlier centuries. Markets had made geography negotiable. That assumption is now revealed as a category error of the first order. What we are witnessing across Eurasia is not a temporary disruption to be managed with monetary policy and diplomatic phone calls, but a fundamental repricing of industrial civilization's most basic input, reliable energy at predictable cost. The implications extend far beyond quarterly earnings reports or election cycles. We are watching the slow-motion restructuring of where goods can be made, where people can afford to live, and which institutions retain the ability to project power decades into the future. The error began with a misunderstanding of what energy security actually means. For the better part of 2 generations, Western policymakers treated energy as a commodity like any other, something to be purchased at market rates from the most efficient supplier. The fact that this supplier was often geographically distant, politically unreliable, or strategically opposed mattered less than the quarterly cost savings. Natural gas flowing through pipelines from the east was cheap. It enabled German manufacturing to remain competitive. It kept French electricity prices manageable. The arrangement worked beautifully until the day it stopped working entirely. From a long-term capital perspective, this was always an unstable foundation. Energy is not a commodity in the conventional sense. It is the substrate upon which all other economic activity occurs. You cannot manufacture steel, smelt aluminum, produce fertilizer, or run data centers without enormous quantities of reliable power. When energy becomes expensive or intermittent, it does not simply increase costs. It makes certain categories of industrial production economically impossible in specific locations. What looked like supply chain efficiency was actually geographic dependency disguised as market optimization. The magnitude of this miscalculation becomes clear when you examine the logistics. Europe's industrial base was engineered around the assumption of cheap Russian gas delivered through fixed pipeline infrastructure. These were not diversifiable supply chains. You cannot simply switch suppliers when your industrial processes, your heating systems, your chemical plants, and your power generation infrastructure are all calibrated to a specific type of fuel delivered through specific physical channels. The capital stock, the factories, the pipelines, the power plants represented trillions of dollars of sunk investment predicated on a geopolitical arrangement that no longer exists. When that arrangement collapsed, it revealed something most analysts had preferred not to examine. Energy independence and energy security are not the same thing. A nation can have access to energy markets without having control over energy supply. The difference matters enormously during periods of systemic stress. Countries with indigenous energy resources or alternative supply routes maintained their industrial capacity. Countries dependent on a single supplier found themselves negotiating from positions of structural weakness, paying multiples of previous prices for replacement supply that often proved insufficient. The immediate consequence was deindustrialization by price. Energy-intensive industries, chemicals, fertilizers, steel, glass, paper, began shutting down operations not because of demand weakness, but because the input costs made production uneconomical. These were not temporary closures waiting for markets to stabilize. These were permanent capacity destruction events. The fixed capital does not sit idle waiting for prices to improve. It deteriorates, becomes obsolete, and eventually gets scrapped. The skilled workforce disperses. The supply chain relationships dissolve. Once lost, industrial capacity of this nature does not return quickly or easily. What makes this particularly consequential is that industrial capacity represents something more than economic output. It represents optionality, the ability to produce what you need when you need it, regardless of what global markets are doing. Viewed through the logic of durable advantage, a nation that can no longer manufacture basic industrial inputs domestically has converted a strategic capability into a market dependency. During peacetime and periods of global stability, this distinction seems academic. During periods of genuine systemic stress, it becomes definitional. The second-order effects are now propagating through systems that seemed entirely unrelated to energy markets. Agriculture, for instance, depends absolutely on synthetic fertilizers, which are produced using natural gas as both feedstock and energy source. When fertilizer production becomes uneconomical in Europe, food security begins migrating from a solved problem to an active concern. Not immediately, not in a way that produces headlines, but in the form of rising input costs for farmers, reduced yields, and increased dependence on imported food from regions that retain their fertilizer production capacity. The same pattern repeats across sector after sector. Aluminum production has largely ceased in Europe because smelting aluminum is extraordinarily energy intensive and only economical with cheap, reliable electricity. The aluminum Europe needs is now produced elsewhere, in China and the Middle East, in places with cheap coal or hydroelectric power. This is not a temporary supply chain adjustment. This is the permanent relocation of industrial capability to regions with different energy endowments and different strategic priorities. Financial markets have been slow to price this shift because it violates the implicit mental model most investors use to understand the world. The assumption has been that capital flows to the highest returns and that production locates wherever costs are lowest. This remains true in a narrow sense, but it ignores the question of whether those returns and costs are stable over relevant time horizons. A factory that is profitable this quarter but depends on energy supplies that could be interrupted or repriced arbitrarily is not the same investment as a factory with secure energy access over decades. The difference does not show up in quarterly earnings until it shows up catastrophically. Geography, which globalization was supposed to have rendered obsolete, has returned as a primary variable in strategic planning. Countries with secure access to energy, food, and industrial minerals are building out manufacturing capacity. Countries without these endowments are discovering that services and financial engineering cannot substitute for the ability to make physical things. This is not a moral judgment. It is an observation about constraints. You cannot eat software. You cannot heat homes with insurance products. An economy built primarily on services and consumption requires that someone, somewhere, is still making the actual goods. When the terms of trade shift decisively, the service economy finds itself negotiating from weakness. The institutional response to this reality has been inadequate, largely because the institutions themselves were designed for a different era. Central banks can manipulate interest rates and purchase assets, but they cannot create energy supplies or rebuild industrial capacity. Governments can provide subsidies and loan guarantees, but capital will not flow to projects that lack fundamental economic viability. International organizations can convene meetings and draft communiques, but they cannot compel sovereign nations to act against their perceived interests. The toolkit available to policymakers was built for managing demand-side shocks in an integrated global economy. What we are experiencing is a supply-side fragmentation that these tools cannot address. What is particularly striking from a risk assessment perspective is how little political will exists to acknowledge the scope of the problem. Admitting that decades of energy policy were built on wishful thinking requires confronting uncomfortable questions about competence and judgment. It requires accepting that the transition to alternative energy sources cannot happen on timelines that match political election cycles. It requires recognizing that energy density matters, that intermittency is not a solved problem, and that baseload power generation cannot be replaced by aspirational technologies that remain unproven at scale. The result is a kind of institutional paralysis where everyone understands the situation is not sustainable, but no one wants to own the political cost of the necessary adjustments. Instead, we get short-term patches, emergency purchases of liquefied natural gas at prices that would have been unthinkable 5 years ago, temporary subsidies to keep key industries operating, diplomatic negotiations that accomplish little beyond delaying the inevitable. These are not strategies. These are holding patterns while structural realities continue to deteriorate. Meanwhile, the industrial capacity that is being destroyed in Europe is being rebuilt elsewhere, in countries that have drawn different conclusions from recent events. China, which already dominated global manufacturing, has accelerated its investments in energy security and industrial self-sufficiency. India is expanding its refining capacity and negotiating long-term energy contracts. Middle Eastern nations are using their energy wealth to build downstream industrial capacity rather than simply exporting raw hydrocarbons. The global distribution of industrial capability is being redrawn, and the countries losing capacity are the same ones that spent decades celebrating their transition to post-industrial economies. From a capital allocation standpoint, this creates profound asymmetries. Investors in the West are being asked to fund energy transitions that lack clear technological pathways or economic viability, while investors in the East are funding industrial expansion backed by cheap energy and growing consumer markets. The returns are not comparable. The risks are not comparable. Capital, which has no loyalty beyond returns, will flow accordingly. This is already happening, but slowly enough that most market participants have not yet adjusted their mental models. The third-order consequences involve questions that current frameworks are not equipped to handle. What happens to the social contract in wealthy nations when living standards decline not temporarily but structurally? What does it mean for political stability when energy costs consume an ever larger share of household income? How do societies that have spent decades defunding their militaries and celebrating the peace dividend respond when they find themselves strategically vulnerable to nations that made different show? ICEs? These are not hypotheticals. These are conditions that are already emerging, but emerging gradually enough that they can be rationalized away as temporary difficulties or blamed on proximate causes rather than structural shifts. The danger is not that the situation will produce immediate crises at least forced decision-making, but that it will produce slow decline punctuated by periodic emergencies, each one managed just well enough to avoid fundamental reforms. History suggests that great powers do not lose their status in sudden, dramatic collapses. They lose it through accumulated strategic errors that seem minor at the time, through the slow erosion of industrial capacity, through the gradual loss of the ability to produce what they need domestically. By the time the loss of status becomes undeniable, the capabilities required to reverse it have already atrophied beyond easy recovery. What makes the current situation particularly treacherous is that the institutions responsible for managing it still operate as though the old assumptions hold. Trade policy is still designed around comparative advantage rather than strategic security. Energy policy is still driven more by environmental aspirations than by engineering realities. Defense policy is still predicated on the assumption that conflicts will be short and that industrial mobilization will be unnecessary because global supply chains will remain functional even under stress. None of these assumptions withstand serious scrutiny. Comparative advantage assumes that trading partners will remain peaceful and that supply chains will remain open. Environmental aspirations do not generate baseload power. Global supply chains do not function during great power conflicts. They become theaters of economic warfare. The institutions that should be recognizing these realities and planning accordingly are instead pending their credibility, defending policies that are failing in real time. The nations that are adapting are doing so quietly, without announcing grand strategies or seeking international approval. They are securing long-term energy contracts. They are building strategic reserves. They are investing in domestic industrial capacity, even when short-term economics do not justify it. They are treating energy, food, and critical minerals as strategic assets rather than commodities. They are doing what serious nations have always done when they recognize that the international system is becoming less stable and more competitive. The contrast in approaches reveals two fundamentally different theories of how the world works. One theory holds that markets are self-correcting, that efficiency always wins, that comparative advantage remains valid regardless of geopolitical context, and that international institutions can manage conflicts without resource to power politics. The other theory holds that security precedes prosperity, that resilience matters more than efficiency during systemic stress, that geography and resources remain fundamental constraints, and that nations ultimately depend on their own capabilities rather than the goodwill of others. For 3 decades, the first theory appeared to be vindicated. Trade expanded, supply chains grew more complex and efficient, and conflicts between major powers seemed increasingly unlikely because they would be economically irrational. The second theory seemed antiquated, the worldview of bitter realists unable to accept that humanity had evolved beyond such primitive concerns. What the past several years have demonstrated is that the first theory worked only under specific conditions that no longer obtain. When geopolitical competition intensifies, when resource constraints bind, when nations prioritize security over efficiency, the assumptions underlying 3 decades of policy collapse with surprising speed. We are not returning to the 19th century, but neither are we moving forward into the frictionless global marketplace that was promised. We are entering something different, a world where economic interdependence coexists with strategic competition, where global supply chains operate under persistent threat of disruption, where access to energy and resources cannot be taken for granted even for wealthy nations. The question that remains unresolved is not whether this transition is happening, that much is now evident, but how violently it will occur and which nations will emerge from it with their capabilities intact. There is a version of this story where the adjustment happens gradually enough that institutions adapt, where new energy supplies come online before old industrial capacity is permanently lost, where political systems prove resilient enough to manage the distributional conflicts that arise when living standards stagnate or decline. There is also a version where the adjustment happens too quickly for institutions to manage, where industrial capacity is destroyed faster than it can be replaced, where energy shortages become chronic rather than temporary, where political systems fracture under the pressure of promises that can no longer be kept. The difference between these scenarios may come down to decisions that have not yet been made, to investments that have not yet been committed, to acknowledgments that have not yet been spoken. What we know from examining how durable advantages are built is that they require long time horizons, patient capital, and the willingness to make investments that will not pay off for decades. They require treating strategic capabilities as ends in themselves rather than as costs to be minimized. They require accepting that security. Thank you and efficiency sometimes conflict, and that in those moments security must take precedence. None of this is emotionally satisfying. None of it produces immediate political benefits. All of it is necessary if the goal is maintaining capability over timescales that matter. The nations that understand this are acting accordingly. The nations that do not are still operating under frameworks that no longer describe reality. The gap between these two groups is not closing. It is widening month by month as industrial capacity relocates, as energy dependencies deepen, as the distribution of power shifts in ways that will not be easily reversed. We are in the early stages of a transformation that will define the next several decades. The shape of that transformation is not yet fixed, but the direction is becoming clearer, and it is not the direction most policymakers anticipated when they designed the systems we are now watching fail.